Hey guys, welcome back. Tony Denaro here. Sunday morning, March 10th, and I thought it might be interesting in light of the GME Q4 earnings and 2023 entire year earnings just in about 2 weeks to go over a comparison of what retail thinks is going to happen with earnings this quarter versus what analysts think. I'm not going to be making any predictions, but I'm going to compare the general consensus from retail versus what analysts think, and then we'll talk about what either one of those scenarios could do to the price after the earnings date. Let's get right into it. Let's start off with a little bit of historical perspective. Since the 4-for-1 forward split back in July of 2022, Gamestop is now down about 70%. If we go back just 1 year to the last Q4 earnings, it's down about 45%. What I have been doing for the last 5 quarters is buying GameStop on the lows pre-earnings and selling into the earnings. I am long on GameStop right now. My cost basis is below the current price because I've been buying the dips pre-earnings here. I want to have a conversation with you about what we think is going to happen, you and I, and talk about maybe what my plan is going to be going into earnings here in just a couple weeks. As we all remember, a year ago on Q4 earnings, there was a massive beat from GameStop and the price jumped after hours from the $16 range all the way up to $26, although due to fundamentals, it did eventually give all of those gains back. Is that kind of beat on earnings and a $10 price run up after hours likely to happen again? Hey, it's certainly possible. It's going to depend a lot on who is right on their analysis this time around, retail traders or the analysts. And we're going to go into a spreadsheet and compare the two scenarios. And I want to hear from you guys which one you think is the most likely to happen. As part of the prep for this video over the past couple of weeks, I have been re-watching a lot of Keith Gill, aka Roaring Kitties videos back from mid-2020. And at that time, he saw an undervalued stock in GameStop. The market cap of GameStop back then was $280 million. We're at $4.48 billion market cap right now. 280 million though back when Keith Gill was looking at it, and he had the book value of the company, or the fair value, somewhere over $400 million. So for him at the time, it was undervalued. Plus the short interest was sky high. Here in 2024 on GameStop, we're looking at a short interest just over 22%. Now, since that time in 2020, GameStop has done a lot of improvements. They've improved the working capital by $700 million. They've tripled shareholder equity and the book value of the company. Investors like myself who focus on the financials and not the more emotional side of the play have to still look at these financials and say, in light of the working capital improving $700 million and the book value tripling to $4.35 or so, is the company worth 10 times what Keith Gill thought it was worth back in 2020? The market thinks no, and that is why fundamentally the price has been driven down. Analysts have a $6 price target for GameStop. We're going to look at the spreadsheet now, and I'm going to show you exactly how they come to that. We'll talk also about retail's estimates for what's going to happen, and then see if we can use those two different data sets to forecast what is going to happen to the price here in just a couple weeks. This is the spreadsheet that I created to track a bunch of fundamentals from GameStop's income statement, balance sheet, and cash flow statement, and to look at a bunch of different ratios that Wall Street is using to analyze this play and give you their forecast for revenue, earnings, and price targets. Let's zoom in here so we can see a little bit better. I know, I'm sorry, this is very small font size. Please forgive me. But what we're going to be focusing on is on the far right-hand side, the retail estimates for Q4 and the total year 2023, and the analysts' estimates for Q4 and the total year 2023. Now, analysts have forecast for 2023 that the revenue is going to come in at $5.61 billion. Earnings per share for the year, positive 11 cents. And you can see that over here on the spreadsheet. I have the 5.6 billion. And after we factor out all of the costs, that gets us down to 11 cents per share for the year. Going over to the retail column, I think most retail traders that I've been keeping an eye on are projecting about 2.1 billion in revenue for Q4, also yielding about $5.6 billion in total revenue for the year. The results, though, are very different when we look at the earnings per share for Q4, retail 62 cents versus the analyst 28 to 30 cents. And they have ramifications for the total end of year earnings per share, whereas the analysts have it at 11 cents. If we go with the retail estimate, we would have positive 44 cents for the year 2023. Now we get into the fun part of comparing how do we get to these two different numbers using Q4 numbers for revenue that are almost exactly the same, revenue for the year that's exactly the same, gross profit that is almost exactly the same for Q4 and 2023. What is driving the big difference here? And the answer is estimates on SG&A. To get to the target forecast by retail traders for SG&A of $370 million, you'd need to have SG&A as a percentage of net sales at about 17.5%, whereas analysts are going with a more traditional, still a reduction in SG&A from previous quarters, but a more traditional in line, about 22.5%. And that makes about $100 million difference in SG&A, and that makes $100 million difference in your net income for the quarter. And that is what drives this huge difference in earnings per share. What is the impact of SG&A? What impact has management had? Are they going to drive it down to 17.5%? That is really the question to think about and to talk about. Now, last year in Q4, SG&A was $453 million on revenue of $2.2 billion. That is about a 20% SG&A percentage of net sales. So you could make the case that the analysts are being too bearish here with a 22.5% SG&A percentage for Q4. You could also make the case that maybe the retail analysts are being a little bit too bullish with 17.45%. That is something that we definitely need to think about. What is the SG&A percentage going to be for Q4? But I think it's also interesting to see how those numbers from both the retail and the analysts factor into the overall SG&A for the year. With a 17.5% percentage for Q4, that gives retail analysts a 23.83 SG&A percentage of net sales for the entire year. And with the analysts at 22.5, that gives them a SG&A percentage of net sales for the entire year of 25%. And if we go back and look at all of the previous years, GameStop has done a great job of bringing this SG&A percentage down. In 2019, it was almost 30%. In 2021, they dropped it to 28.45%, 28.36% for 2022. For each quarter of 2023 so far, 27.9%, 27.7, 27.5, and now we think we're going to cut 10% off of the SG&A in one quarter. This is what I want you guys to think about. We can see the history here of the annual cost reductions, the percentage decline every single year. Is GameStop going to drop from 2022 at 28.36% to what the analysts are forecasting, a 3% drop, 25%, or retail's estimate of about a 4.5% improvement to 23.83%? Compared to 2022. Now that we know the lay of the land of both scenarios and how we get there, let's talk about the implications of either one being correct. And I'm going to focus on the PE ratio. The analysts have, as we said for the year, 11 cents positive earnings. That imputes a PE ratio of 131. When we look at a PE ratio, we're talking trailing 12 months, and the trailing 12 months earnings for GameStop will be positive 11 cents. With the price of $14.65, the PE ratio would be 131. If the analyst scenario is correct, when we look at things like the PE ratio, price to free cash flow, or even the book value of $491, it's going to tell the market that at $14.65, GameStop is still overvalued. On the positive side, though, if we look at the retail analyst forecast of 44 cents positive earnings for the year, that would give us a PE ratio of 33, a price to free cash flow ratio of 32. And we still have to deal with the book value being far below the current price, but the PE ratio is in a range that I would consider acceptable. To tie up all the loose ends and try and figure out why the analysts have a $6 price target, keep in mind that they have earnings forecast for the year at positive 11 cents. And if we look at the top middle of the screen here, if we give GameStop on 11 cents annual earnings a pretty high PE ratio of 54, that gets us a price target in the $6 range. There are a lot of other unknowns that we haven't talked about today. What are they going to say in the earnings call? Is it going to be a short call, or are they going to have something to say this time around? What is Ryan Cohen doing investing the company's money? Did he make any progress in that area in the last quarter? Are they going to have some sort of acquisition announcement? Lots of different things we could talk about that completely change these numbers. The intent of today's video is to try and help you see the difference between where retail minds are at right now versus analyst minds, and what happens to the earnings and the PE ratio depending on which scenario plays out. If we come in at a PE ratio on the retail side of 33, I think the price could very comfortably hang in the range that it's at over the long term. We know there's going to be volatility around earnings. Anything could happen. It could go up $10. It could go up more on earnings. There's going to be some momentary volatility. But if the PE ratio comes in at 131 on 11 cents of annual earnings, I would expect that the market is going to want to apply additional negative pressure to the price of GameStop, because 131 is just too unsustainably high. I'll put a link in the video description to this Market Chameleon page where you can go look for yourself at the various PE ratios of companies in different sectors. The cyclical retail sector, you can look at specialty retail, you can look at electronic stores, however you want to sort it, and you can kind of get a feel. There's many pages here. You can get a feel for what a PE ratio is for a company in GameStop sector. And they're kind of all over the map. And if you find one that you like, dig into the finances of that company and see how you feel that it compares to GameStop. So those are the kind of two scenarios that I'm looking at. We're going to find out together in a couple weeks which one is correct. I want to know your thoughts. Drop me a comment down below or a question, and we can talk about it a little more. I am Tony Denaro. Thank you for watching, and I will see you on the next one.